Amazon's e-commerce business will likely retain its dominance in the market for multiple reasons, despite the emergence of rivals like Walmart. Firstly, Amazon's AWS segment constitutes a large and growing portion of their total revenue. This major stream of net income enables the company to keep their prices competitively low. None of Walmart's high-margin businesses match AWS in scale. Secondly, Amazon's e-commerce platform is of higher quality. It provides a more advanced suite of marketing and advertising tools, is the more popular choice for rather niche items beyond groceries, and operates in more geographical regions. Thirdly, Amazon is directing a large portion of their investments at technological advancement. Amazon is expanding their logistics network into more local areas so they can provide their same-day delivery service to more customers. Additionally, Amazon is also building robots to facilitate multiple aspects of inventory management, such as selecting individual items, loading carts, and moving them around. Amazon is also working on improving and expanding their drone delivery service, which allows for ultra-fast transport of items under 5 pounds. Regular customers pay $10 per drone delivery, while Prime members pay $5. This serves as a devastating blow to Amazon's brick-and-mortar competition, significantly bolsters their high-margin Prime subscription business, and increases operational efficiency over the long term. AWS, Amazon's biggest source of net income, faces much stronger competition from Microsoft, Azure, and Google Cloud Platform. Nonetheless, Amazon Web Services has multiple critical advantages that make it well-positioned to capture a large portion of new market share. AWS was released in 2006, and it was adopted by many enterprises rapidly before the emergence of its rivals. In the context of cloud computing, switching to alternative platforms requires inconvenient tasks such as moving massive amounts of data and re-establishing security protocols. The tools on different platforms are not interchangeable, so you need significant levels of expertise to effectively replicate your business on a different cloud platform. Additionally, while Azure and GCP take a more automated approach, AWS lets you fully manage the operational aspect of your business with a higher level of granularity, including networking, compute, and security. While individuals and startups prefer more streamlined systems since they don't have to manage their infrastructure at a deep level, large enterprises favor AWS because it can cater to their needs better than other platforms and ensure that their projects can operate at a global scale with maximum efficiency. When it comes to artificial intelligence, AWS holds a distinct edge through its custom silicon strategy and wide collection of models. While Google's TPUs offer immense raw power, they require specific software optimizations to reach their maximum potential. Amazon's Trainium chips provide native support for PyTorch, a software library that is considered the industry standard for AI model development. Unlike Google, Amazon has also developed its own CPUs, known as Graviton chips. In an AI system, CPUs break down goals into sequential steps and effectively orchestrate GPUs and ASICs, which handle the complex calculations and thinking. While this was merely a background task in generative AI, it's now become a crucial step to running a proactive system. Amazon also offers the widest selection of third-party models, including Claude, Llama, and ChatGPT for agentic development. Since AI models can frequently overtake each other in intelligence, Amazon's agnostic approach is crucial as it eliminates the customer fear of being forced to develop applications with an inferior model. I model AWS revenue growing 30% in fiscal year 2026 as capacity constraints such as power and semiconductors resolve, which enable Amazon to fulfill the overwhelming demand they're receiving. Growth trends in other areas are likely to stay consistent. I predict that online store revenue, Amazon's largest revenue source, will grow 10% due to improvements in delivery speed. Additionally, I forecast that Amazon's advertising business will continue to grow at 22%, bolstered by their suite of AI content creation tools. Amazon's subscription business and third-party seller revenue should maintain their growth rates of 15% and 11% respectively, while their physical store revenue growth will likely decelerate to 5%. I predict this margin will reach 7% in 2026. According to Amazon's guidance, their total operating margin in Q1 of 2026 will be around 10%, lower than their margin of 11.2% in fiscal year 2025, which was impacted by special charges. While Amazon's investments will translate to improved efficiency and quality of their services, those improvements take multiple years to fully materialize. This guidance reinforces my theory that the positive impacts of Amazon's operational efficiency will be neutralized by Amazon's significant increase in capex. According to my model, Amazon will generate $106 billion worth of operating income in 2026. This translates to an operating EPS of $9.86. Multiplying my operating EPS estimate of $9.86 by 28 yields a price target of $276 per share by the end of fiscal year 2026. Developing Gemini and integrating it into search bolstered advertising revenue while rectifying the concern that generative AI would weaken Google's core business. Google Gemini effectively does the task of finding products that suit a customer's needs for them, converting browsing into purchases faster than ever. Additionally, Gemini is superior compared to other models in terms of its multimodal capabilities and ability to maintain near-perfect accuracy across its giant context window. Coupled with other products on Google Cloud platforms such as BigQuery, the fastest data warehouse offered by any major cloud computing platform, GCP becomes the most ideal for AI innovation and data analytics. GCP is in a solid position to capture a large portion of incoming AI-driven demand. While many enterprises are still glued to AWS due to its earlier release and more granular settings, GCP is arguably the superior choice for AI development, which is driving the majority of incoming demand for cloud services. One of GCP's core products is BigQuery, a massive data warehouse that can process petabytes of data in minutes using standard SQL without much prior management. GCP also provides direct access to Gemini models through Vertex AI, a platform for building and deploying AI agents. Gemini excels in video and image analysis and maintains significant accuracy along its large context window, making it a compelling choice for large-scale research. GCP also offers the best hardware of any cloud platform for AI training. Google's Tensor Processing Unit is a chip that's exclusively designed for AI calculations and can scale linearly in enormous clusters due to its networking mechanism, which basically relies on light. The combination of these products creates an ideal environment for AI development and large-scale data analysis. Multiple businesses have the potential to experience growth accelerations in 2026. I model GCP growing at a 50% rate, as its various structural advantages make it the ideal choice for AI researchers. Gemini's superior multimodal capabilities, large context window, and native integration with Google's ecosystem make it a fierce competitor to ChatGPT, which is the current leader in the generative AI market. I therefore expect Google's subscriptions revenue growth to accelerate to 20%, driven by Gemini. I also expect a 15% increase in Google search revenue. Product recommendation algorithms on Google Search, in terms of the speed at which they convert searchers into buyers, still have room to improve, giving the company more opportunities to capitalize on. YouTube ads and Google Network will likely be the laggards of the year. I model YouTube advertising revenue decelerating to 10% as growth rates continue to cool down since YouTube Shorts achieved mainstream popularity. Shorts faces fierce rivals such as Instagram and TikTok, which boast more personalized and addictive algorithms, along with more socially engaged communities. Additionally, the success of Google's other businesses backfires on YouTube ads revenue. One of Google's fastest growing subscriptions is YouTube Premium, which blocks the owner from seeing any advertisements on the platform. And Gemini's ability to summarize entire videos in seconds can negatively impact engagement times on the platform, which translates to further reductions in advertisement revenue. Google Network, a product customers can use to place advertisements on other properties not owned by Google, faces the same problem since Google itself now has become the most popular choice for advertising on the internet. I forecast Google Network revenue declining by 2% in 2026. Based on these predictions, Google Services revenue will reach a total of $389.4 billion, and Google Cloud's revenue will reach a record of $88.1 billion in 2026. I forecast the operating margins of these segments reaching 42% and 30% respectively, up from 41% and 24%. High-margin subscription revenue from Gemini Pro and YouTube Premium should continue to drive slight increases in the operating margin of the Google Services segment. Meanwhile, GCP's margins should continue to dramatically improve after years of unprofitability. However, Google's massive capital expenditures will probably keep GCP from reaching the operating margins of rivals AWS and Azure, which are approximately 35% to 45%. Capital expenditures will also increase the cost of research and development significantly, along with other alphabet-level operations. Therefore, despite the large scale of these individual improvements, I model Google's overall operating margin reaching 32.5%, up only slightly from 32% in 2025. This would translate to $154.1 billion in operating income, which makes Google's operating EPS $12.74. Therefore, at an operating PE of 28, Google's target price is $356 per share by the end of fiscal year 2026. The tightly interwoven nature of Microsoft's ecosystem of services is foundational to the software giant's success. Owning one Microsoft product entices you to use their other solutions due to advantages such as seamless integration, cost savings, and vendor consolidation, which all heavily attract large enterprises. In 2026, tensions regarding their partnership with OpenAI have caused the stock to experience a greater downfall than Amazon and Google. While I believe they should be factored into the stock price, it does not change the fact that Microsoft has a fundamentally good business model. Microsoft's flow of revenue started off with the interconnected nature between their Windows computers and Microsoft 365 suite of applications. While M365 apps have steeper learning curves and are more difficult to use than rivals such as Google Workspace, making them less popular among educational institutions and individuals, they are highly attractive to large enterprises due to their more granular and advanced features. This suite includes Word, Excel, PowerPoint, and Teams, which serve as the cornerstone of business productivity. However, these applications can only reach their maximum potential through features that only Windows computers support, such as Power Pivot, which makes Excel capable of reaching its multi-billion limit of rows of storing data. Therefore, it's in the best interest of a corporation to use M365 if they use Windows computers, and vice versa. To complete Microsoft's monopoly on enterprise software, they acquired Dynamics and LinkedIn, which handle customer relationship management and networking/employment respectively. Coupled with M365, using these applications come with additional benefits such as discounts and vendor consolidation. Additionally, large corporations in the M365 ecosystem were inclined to license SQL and Windows Server. SQL Server is a relational database management system that can store massive amounts of unorganized data, which can then be transferred to Excel for complex analysis. Meanwhile, Windows Server is a special operating system that enables a single computer to administrate thousands of others through a singular access management system. This operating system supports corporate environments by providing structured organization of the permissions of different employees and departments. Despite releasing 4 years later than Amazon Web Services, Azure arguably warrants a larger moat since it was built entirely off of Microsoft's existing solutions. To increase the likelihood of existing enterprise customers migrating to Azure, Microsoft created the Azure Hybrid benefit, which allowed on-premises Windows and SQL licenses to be moved onto the cloud. A major part of the cost of using cloud computing services is the infrastructure layer. Therefore, by already owning Windows and SQL, the cost of using Azure decreases by over 40% for an enterprise customer. Additionally, using a rival platform like AWS or GCP would require enterprises to recreate access management systems. Meanwhile, under the Microsoft Entra ID system, an enterprise can easily extend the same system of authentication and user permissions for M365 to Azure. This facilitates the development of machine learning algorithms and data analytics applications through enabling direct and convenient access to M365 files. The integration of AI has proven revolutionary for Microsoft's entire catalog of services. Purchasing the Copilot subscription greatly extends the capabilities of M365. It can create models and documents on its own through simple text-based prompts and bridge the gap between different media types, which can effectively convert data on one application into a project on another. Like other cloud platforms, Azure also provides the infrastructure to build autonomous AI systems. In 2023, Azure's distinct advantage was its exclusive access to cutting-edge GPT models, enabled by Microsoft's partnership with OpenAI, making it the earliest platform to start capitalizing on incoming AI demand. However, unlike Google and Amazon, Microsoft is currently facing a structural threat to their business. Their partnership with OpenAI slowly deteriorated into that of a liability. OpenAI is struggling to fulfill their commitments and pay off their debt due to the emergence of competitors triggering slowdowns in their revenue growth. The aggressive pacing of their capital expenditures relative to their revenue growth has created a vacuum that will likely keep OpenAI from becoming profitable until 2030. Prolonged unprofitability or bankruptcy can have a significant negative impact on Microsoft's income over the next few years, due to their massive equity ownership stake in the company. Additionally, Microsoft Azure growth decelerated from 40% to 39% in the second quarter of fiscal year 2026, driven by their allocation of compute resources to OpenAI and internal operations. However, tensions regarding this partnership have had a disproportionately negative impact on Microsoft's stock because the company still operates an independent and highly successful ecosystem. I modeled Microsoft's productivity and business processes segment revenue growing 15% in the next year with an operating margin of 59%, driven by Copilot subscriptions. I forecast the Intelligent Cloud segment growing 32% with an operating margin of 42%, driven by Azure growth of 42.5% due to its significant advantages over rivals despite capacity constraints. Finally, I modeled the more personal computing segment growing 2% with an operating margin of 27%. I expect Microsoft's Xbox business to continue declining as consumers shift to mobile and desktop gaming, while their consumer electronics business will remain flat as it has little room for growth in the enterprise customer base. According to these estimates, Microsoft will generate $171.7 billion in operating income, which translates to an operating EPS of $23.01. This means at an operating PE of 25, Microsoft's fair value is $575 per share.